Thanks for tuning in, everyone, and welcome to our second quarter market and economic overview. We sincerely hope you and your loved ones have been spared of COVID-19 and are coping with the many aspects of life it has changed. As usual, we kick off our call today by citing some of the obvious elements of the environment that are worrisome, but also some silver linings. On the right, we see that first and foremost, this health crisis is continuing. In fact, it might even be getting worse. We have no idea how long it's going to last, or what the economic fallout is going to be, or how long it's going to take for us to get back to normal. That said, on the left, we show that there is evidence that while not a great outcome in terms of the pandemic, reopening the economy has been and will be a path back to normalcy eventually. And also, while some investors can't wrap their head around stabilizing stock prices, we actually look at this as reassuring that markets are behaving as they should, looking at long-term fundamentals rather than short-term earnings disruptions. While it sure feels like it's been going on longer, the current recession is still in its infancy relative to prior ones. This chart shows a timeline of past recessions, with the size of the bubble representing its magnitude and the y-axis showing its duration. As you can see at the far right of the screen, the current recession is already the second largest ever, but is still not even half as deep as the Great Depression, the largest ever, which also lasted 3.5 years. One of the things that commentators like to talk about is the so-called shape of the recovery. It's based on the notion that economic output, measured by GDP or gross domestic product, should normally rise over time. A recession, or even just a slowdown in GDP growth, results in an abrupt downslope of the GDP line, so it's in our interest to get back on pace. A V-shaped recovery is ideal, a U-shape is slightly prolonged, and W reflects a stop and start. There are many varieties and versions of the potential shape of the recovery, and it makes for interesting conversation, but nobody really knows. My favorite quote on this matter was from Richmond Fed President Thomas Barkin, who said, "We took the elevator down, but we need to take the stairs back up." Importantly, GDP is not a good predictor of stock returns, as we show in detail elsewhere in our slides. This slide is a great graphic that shows you the magnitude of the slowdown in the transportation industry from a year ago today. The gray bar represents the number of passengers a year ago who passed through TSA checkpoints, and the red line shows that number this year. You see a dramatic decline, which not only has impacts for the airline industry, but if you also think about fewer travelers needing fewer services at their destination points, such as hotels, restaurants, and that sort of thing, you can definitely see the magnitude of the economic impact of a slowdown in travel. You may hear comments and reports about the Federal Reserve's balance sheet. This had been a fairly sleepy topic until the great financial crisis, when Ben Bernanke's Fed purchased government bonds and toxic assets to save the financial system from ruin. Critics argue that this practice is antithesis to free markets, but it definitely opened the door for future uses of the tool. At the far right, you can see that the Jerome Powell Fed has taken the idea and run with it, supporting many parts of the market, including money markets and corporate bonds, even buying some ETFs and junk bonds. Part of the Fed's bond buying supported bond prices during the quarter, which is shown by the grouping of bars at the left side of this graph. In particular, the orange and blue bars, representing short and intermediate term corporate bonds, were up about 6% and 10% respectively. Looking at the same orange and blue bars in the middle section of the page, you see lower year-to-date returns than for the recent quarter, which reflects the negative performance of these categories in the first quarter. The yellow bar in the year-to-date section reflects the fact that U.S. Treasury bonds remain a safe haven for investors in times of uncertainty. To put this in perspective, on December 31st, 2019, the yield on the 10-year Treasury was 1.92%. That means the expected return, if held to maturity from that point on, was 1.92% annually. A return since then, until now, of 9.6% has to be interpreted as a reduction of expected return from this point forward. The yield curve reflects the current yield of Treasury bonds of various maturities and also represents the total return you can expect by holding each bond to its maturity. Let's look at the 10-year bond on the solid blue line. As I said earlier, on December 31st, this yield was 1.92%, but after a 9.6% price appreciation, it is now only 0.66%. So that is the expected return that we would have for holding that particular bond till its 10-year maturity. Now, one might wonder whether it's even worth it to hold such a position with such a low yield. And this question was one that we worked very diligently on over the last few months. Our conclusion was that yes, despite the low yield, the insurance policy that intermediate-term Treasury bonds provides against the stock market decline is an important element of the portfolio. If Treasury yields were ever to go to zero or negative, we would surely revisit this topic. We do suggest having other kinds of bonds in the portfolio to provide diversification and additional expected return. Those types of bonds might be investment-grade credit, municipal bonds, or in some cases, upper quality levels of high-yield securities. If you've tuned into our calls before, you know that we always include a comment on inflation. This graph shows the high inflation era of pre-1990 at the left side and the stable inflation era since at the right side. One thing we shouldn't lose sight of, just because many of us haven't experienced inflation in our careers, is that it may not be gone forever. Many are currently wondering if all this government stimulus will lead to inflation. We tend to think of the government spending as aid instead, backfilling lost productivity rather than stimulating growth. Especially with high unemployment and diminished spending, we see very little evidence that the economy could overheat in the short term. Over the long term, it is difficult to say for sure, so we think the best bet is to try to stay insulated from inflation in your portfolio. For most long-term investors, growth-oriented assets like stocks and real estate should help outpace inflation. For ultra-conservative investors with low equity weights, we suggest an allocation to short-term inflation-protected securities, or TIPS. Be careful though, because TIPS are highly interest rate sensitive and can be more volatile than expected. Turning our attention to stocks, we see the quarter, year-to-date, and 12 months returns for US size and style indices on this chart. I'm starting to feel like a broken record, saying once again that it's large cap growth leading the way, reflected by the gray bars for each period. Furthermore, there's a deep divide between the returns of large cap growth and that of small cap value, as evidenced at far right. Where your portfolio stands on this continuum is likely going to define the story of your performance over recent periods. We suggest caution and to resist the impulse to adjust your portfolio towards large cap growth based on performance, as we believe and have observed that markets run in cycles. One element of the large cap growth story has been that of the FANG stocks: Facebook, Apple, Amazon, Netflix, and Google. The graph shows that these 5 stocks now account for 20% of the S&P 500, as shown at the right side of the page. Just 5 years ago, the top 5 stocks in the S&P accounted for closer to 11%, though it may not have even been the same 5 stocks. If you look at the NASDAQ, not shown on the page, these stocks account for about 45% of the index, so you know that they have been a major driver of the returns of large cap growth. While we know better than to bet against Apple or Amazon, we also feel like there are many other great companies out there, many of which are trading at attractive multiples, and that diversification is always important. Some investors are expressing concern that the stock market is too optimistic and detached from the reality of the health crisis and/or the state of the economy. While we're not suggesting the pandemic can't get worse or last longer than expected, or that the stock market might fall for some other reason, we feel compelled to distinguish the market from the economy. If you look at the blue line on this page, representing the S&P 500, you see that its decline was fast and furious and occurred before 2020 economic forecasts were revised downward. As economic data rolled in, the stock market was already seeing through a few quarters of depressed earnings and starting to price in the fact that the economy will recover and companies will return to business. We're sure that the Fed's support offered a stabilization of investor sentiment as well. All that being said, we do not espouse a strategy based on prognostication. Rather, we suggest taking a balanced approach and having and sticking to a rebalancing strategy that would put emotions and guesswork aside. With that approach, you'll always be in a position to buy on the dips and limit your client's exposure to what is tolerable. Turning to non-US stocks, we see a similar story as in the US, with second quarter returns strongly positive, but not enough to pull the year-to-date figures out of the red. Unlike the US, the rest of the world's stock market doesn't have the tech stocks that have propelled the US market. One interesting thing we're watching is how well various countries and regions slow the spread and impact of the virus. It stands to reason that the sooner a country can get back to work, the sooner their economy and earnings could rebound. As the graph at the left shows, North Asia, which includes Japan and China, seem to be under control, and Europe appears to have flattened their curve, while the Americas and Southeast Asia continue to get worse. It will be interesting to see if investors draw any conclusions from this and reallocate capital accordingly. A reallocation of capital away from the US could have impacts beyond asset prices. In fact, if capital flows out of US dollar denominated assets, the dollar itself could fall. Owning stocks outside the US is the easiest way to hedge our dollar-based consumption, meaning that if we own assets abroad and the dollar declines, those holdings will have provided positive returns, all else equal. The top graph on this page shows the general appreciation of the dollar relative to a basket of foreign currencies over the past 10 years, while the bottom chart shows a weakening of the dollar over the past 3 months. Turning away from market-related information, we thought you'd enjoy the results of this survey about remote working. In it, respondents cited the flexibility of scheduling and working location as top benefits of moving away from the office. Personally, I enjoy not having to drive to an office and to fewer meetings that used to be in person. It saves time, parking, probably some money from grabbing meals out, and gas, and many environmental studies show that the air is cleaner than it's been in a long time. We know there are challenges such as childcare and distractions at home, so we hope you are all surviving and making the most of it. As always, we conclude our presentation with a reminder to focus on what matters and what we can control. The items on this page are things that are all within our control and things that we should focus on, rather than trying to predict the direction of the market or the future state of the economy. This time, we highlight the final bullet point in the list to rebalance the portfolio as necessary. Generally speaking, we recommend to have a target asset allocation that's appropriate for the client's risk tolerance and rebalance back to that position as necessary. When markets become dislocated for whatever reason, by sticking to that disciplined process, we can keep our client portfolios in the appropriate risk tolerance, keep them on track to meet their financial plans, and like we saw in this period, we could be in a position to buy into the stock market on the dips, as they say. So having that discipline to do so is a very important component of our portfolio strategy. Thank you very much we appreciate your time. Look forward to any follow-up questions you might have, and we'll see you next quarter.